everybody really looks forward to is our Diwali interaction with Prashant Jain to understand his insights, where he expects there could be value migration in this market, where there are excesses in the market, and what about valuations and the earning mix. All that and much more on this Diwali special with none other than Prashant Jain. Mr. Jain, first, Diwali greetings to you and your team. The current Samvat year, even though last couple of days have been quite volatile and choppy, in general is a Samvat where massive wealth has got created in equities, real estate, and also gold.
Yes, Nikunj, you are absolutely right. And I wish you, your colleagues, and your viewers a very happy and prosperous new year ahead as well. And I would agree with what you said, though the current year looks to be one of moderation. And I think it is always good to have a moderate year after strong wealth creation, and it sets the base for future returns. So I think I would echo your sentiment. Yes.
Mr. Jain, you've been a big votary of mean reversion over the years. The way you've managed money both publicly and now for your private clients, you've always said that markets, they follow a cycle. Cycle means that there is mean reversion. If one has to assess this bull market cycle, where are we in this cycle? Are we anywhere closer to euphoria, bubble and a bust, or we are nowhere close to that part of the cycle?
I think, I think it would be unfair to answer this question for whole markets because there has been considerable divergence between large caps and small mid caps. So I would say in large caps, we are very close to fair value. I think there is very little room, probably no room for multiples to move up. But I think we can by and large justify these multiples in aggregate terms for the large caps. I think the challenge for the markets, as me and many others have been highlighting for a while, is in the small and mid caps. And that is the space, I think, which is clearly ahead of fundamentals. The multiples are extremely rich. And I think in many places, the earnings will disappoint. So the downside in those spaces is what appears to be more. The risk reward is clearly in favor of large caps, in my opinion.
So are we going to go through that phase that for last 3 years we've used the word a secular bull market? It was a rising tide phenomenon. Now it is going to be a differentiated, not delivering. Within IT, the same trend. Within auto, the same trend. Are we going to go through what really could be called as a market where a bull market and a bear market, they would coexist? Within a sector, some banks are delivering, some banks are. Non-secular bull market where very few stocks will go higher.
Yeah. Yes, I think Nikunj, the dispersion in future performance should be probably more in these markets because valuations are by and large quite reasonable, not much upside. In aggregate terms, multiples are fair. But I think as results come out, as growth disappoints or is in line or exceeds expectations, I think the divergence in performance across sectors and across individual businesses could be more going ahead. You are right.
What do you make of the current leg of the earnings season? We are getting more downgrades, hardly any upgrades. Even though economy is growing at 8%, there seems to be a struggle when it comes to individual companies and the kind of commentary we are getting from autos to FMCG, from consumer to even consumer discretionary. All companies are now struggling. Why is that? If the economy is growing, then why why earnings are contracting?
I think there can be some differences between economic cycle and business cycles, and that is what we are experiencing here. And we have actually been sharing, suggesting that the profit growth rates need to come down very sharp. See, there are two things here. One, the overall economy, while the real growth is 6 to 7%, India is now a lower inflation economy. So our inflation is broadly 4 to 5%. So which means your rupee GDP, nominal GDP is growing around 10-11% a year. So longer term earnings need to align with that lower inflation environment, lower nominal GDP growth rates. The last 5 years earnings were supported massively because corporate profitability base or margins were extremely low post-COVID. We have seen a complete recovery in corporate profitability, in corporate margins. Our aggregate corporate profitability is very close to previous peaks. So I think future profit growth through margin upside appears to be limited, especially in most of the sectors. So I think in aggregate terms, one would expect profit growth to be around 12 odd percent over next few years. I think regarding the sectors which you mentioned, consumer-oriented sectors, I think what one has seen over last few years, and we have written about this also, that the consumption in last few years was supported by rising retail leverage, by rising household leverage. And I mean, it's very logical whenever you borrow and spend, at some point in the future, you have to slow down. So I think that is the phase that what we are experiencing. I would not worry too much about this from a medium term perspective, but near term, you are right that the consumer demand appears to be somewhat weak.
The script of how Indian markets have moved has been deeply influenced by local flows, be it HNI investors, family office, or the SIP investors. Uh, when you have such a large inflow, which looks like is a committed flow for in the near term, how do you see market reacting? Because even though FIs are selling, the local flow is making all the difference.
No, you are right, absolutely, Nikunj. But what you also need to add to that equation is the supply of new stock. So the IPOs, the NFOs, the sell downs, I think is very significant. It is very large, and you are seeing multiple billion-dollar IPOs getting concluded in the recent past. In the future, many are in the pipeline. So I think, and that is so the source of supply is twofold: the foreigners and the new stock supply. And this is the reason why I think markets have corrected.
You've been echoing your thoughts on small and mid cap. It's taken almost a year for markets to realize that there was euphoria and bubble there, and now these stocks have started correcting. Where are mid caps headed? And within mid cap, where do you think the vulnerability to valuation is the highest?
Think, Nikunj, I think yes, we have experienced this many times in the past also that what is expensive can become more expensive, and what is cheap can become cheaper because before mean reversion sets in. So I think the significant wealth creation, small mid caps, because of the extremely low base set during COVID, create higher wealth if measured from that point of time. And that is why a lot more people participated in that. And that is what has led to sustained outperformance. That space, I think that cycle seems to be changing now. So I would say that the multiples in small mid caps, generally speaking. See, the universe of small mid caps is so large, runs into many, many hundreds of companies, probably even more, that there will always be some businesses, one in 10, one in 20, which can outperform even in this type of a market. But by and large, I would be cautious in the small mid cap space. And I think earnings can disappoint, multiples are very high, supply of new stocks by way of new companies coming to the market is also quite high. And once the momentum breaks in a place where there are excesses, valuations are ahead of fundamentals, it is unlikely that this trend will reverse in a hurry. That is what one has seen in the previous cycles.
So, going by what your newsletter is and what you've been expressing, can I, before I move to themes and sectors, can I say that the prudent strategy, according to you, of course, each one has to look at their own risk profile, but the prudent strategy, according to you, is not to sell out of equities, but perhaps within equities, move from small and mid cap to large cap?
So I think this is a market where one should reset one's return expectations. I think that is most important. I think if we expect low double digit returns from Nifty over 3, 5 years, I think these are realistic expectations. I don't think we should continue to expect higher returns from small mid caps. That would be a wrong expectation, in my opinion. See, the way I see Indian equities, if you look at annual returns of equities. A 10-15% volatility in equities is very normal, even without anything significant happening. And once in a while, when there is a crisis year, let's say it was Lehman or 9/11 or COVID, the falls can be sharper. So I think you should invest that much in equities, remain invested, on which you can tolerate these kinds of volatility and expect. But yeah, I think the key is to tone down your return expectations. People don't get excited by a 12% CAGR in equities. But I think that's it can create significant wealth if you invest with those returns for longer periods of time. And in any case, I think those are the likely returns in my opinion. Also, one cannot ignore the significant difference in taxation between equities and fixed income. So, at 5% post tax returns on fixed income, it will take 14 years to double your money. But in equities, I think we can probably double money, at least in large caps, over a 6 years or so. So over 14 years, 100 becomes 500 in equities. I think that type of an approach, that type of expectation should be the right one for equities.
Okay, I'll now move to the next leg, and I just want to bring this out for the benefit of our viewers that I've had the pleasure of interacting with Mr. Jain for almost 2.5 decades now. His ability to really find value in this market and really ahead of the curve is quite extraordinary. For example, PSUs, corporate banks, identifying manufacturing, staying out of IT when there was absolute bubble and trouble there, avoiding mid caps in 2014-15. These have been some of his classic calls. And in COVID, well, he went all out on ET Now. I distinctly remember when he said that it's time to buy the fear because stocks were available, gold was available at the price of silver. So let's take that theme forward. Where do you think this market right now is offering value for a value investor like Prashant Jain?
Yeah, I think first and foremost, this is a market where there are, to my mind, no pockets of deep value. So up till now, what one has seen in different cycles, that some pocket or the other was deeply undervalued, whether it was non-tech in 2000, whether it was non-infra in 2007, whether it was, PSUs, corporate banks, capex, manufacturing few years back, uh, utilities, etc. In this market, deep value is hard to come by, to my mind, and one has to be satisfied with compounding returns, as we discussed earlier. Yet, on a relative sense, I feel the banks are offering relatively better value, and that is what has been the case for some time. I think there the while earnings growth will be in low to mid teens, I think there is some scope, a limited small scope for multiples to re-rate as well. At least the multiples don't appear to be excessive. Chances or room for a de-rating in multiples is probably not there. So I think that would be the most preferred place to my mind.
But if the economy slows down, is it a good idea to buy into banks? Because there are cracks which are opening up, be it private banks or small banks or even banks which have exposure to microfinance. Without getting into specifics of names here, but the banking numbers so far have not really been extraordinarily satisfactory. They are feeling the heat of the economic slowdown.
So I don't think the economy is slowing down, but I do feel that consumption is a bit slow. And at some point, it was bound to happen because household leverage has gone up significantly. And even the central bank is somewhat concerned with that. And you are right, when consumer leverage is high, the most vulnerable pockets of consumer lending will suffer some slippages. So we are seeing some higher slippages in MFI loans, in unsecured personal loans, in credit card loans. So I would prefer the large banks where the exposure to these segments is extremely small.
That there's continuous FI selling and FI largely have a large exposure to banks. Could that be a limiting factor? And also Manish Chokhani of Inam told me that financials have a combined market cap of $1 trillion in a market which is about $4.5 trillion. Won't that be a concern? Because if this sector is already commanding a jumbo market cap, then it will be difficult for this sector to go against the FI selling.
Oh, you are right, and the FI selling has been going on for few years now. Which so this was the most popular, the most overowned sector in India for many, I would say, probably few decades. And but we have seen considerable sell downs happening in this space, and so I still feel that if you take a slightly longer term view, this space has see the derating of this sector has taken place because of two reasons. One, growth has slowed down, and there has been consistent selling by foreign institutions. But today's valuations, I think, align well with the current or likely growth rates of this sector.
If you like this video, then like, share and subscribe to ET Now.